Happy New Year, everyone, and welcome to this stock analysis update for Rockhopper Exploration. Of course, the reason why I'm doing this is because the share price has gone up by 160% since mid-November. So I'm going to be taking a look at why did that happen, and I'll also take a look at the other update since I last did a video on them, which was last June. Before I start, this is not investment advice, and speak to a qualified investment advisor before making any investment decision. So when I last looked at them, they'd just achieved the Abrima Mayer monetization, which included a first tranche award of 19 million euros. And I first started covering Rockhopper back in 2022. If you look, I've got hours and hours of content on them on my YouTube channel, where I really go back into the deep lore. But this video is just going to be an update for what's happened since the last video. And for many years, ever since I first covered them, they were constantly about to run out of money. You can see on my timeline here these points where they were going to run out of money. And they always managed to limp along using capital raises and things. Well, this monetization completely changes things. They've now got plenty of money to last up until the FID with Navitas. And if I take a look at the amount of cash they have as current assets, you can see how they were really running out of the money, on the verge of going bankrupt. And they're now, thanks to this cash injection from the first tranche of the Abrima Mayer monetization, they're now flush with cash. They're a completely different profile, actually, compared with a year ago. They've got kind of a pristine balance sheet. There wasn't really much of a response in the share price, and anyone who had these on their watch list could have responded to that and be well rewarded. As it was for me, I'd already invested back in this for the second time back in January last year. There's also actually the potential, if the Italian government are finally forced to pay up, then Rockhopper should get perhaps 65 million in a second tranche this year. Then in September of last year, their half-year report came out, and we see, of course, here's that in US dollars, 21 million, which is their monetization of the Abrima Mayer award. On the expenses side, we see their cost of sales reduced as they've continually shut down their Italian operations, and their admin expenses quite reduced to actually about 3 million a year. That's thanks to shutting down their Rome office, and actually because of their monetization, that got rid of about 3 million of legal costs that they were having to pay every year. So on top of the healthier cash balance, in terms of their actual cash burn and normal running costs, in this by mid-24, things were looking very healthy, actually, because they'd really reduced their normal running costs, and we were looking at a burn rate of perhaps about 3 million a year. You can see that their long-term assets are purely their exploration and evaluation assets, and as they start investing in Sea Line now, we can see that number increase. And they still have this 20 million of provisions, which is a long-term liability related to all those Italian assets they had, which are kind of mothballed at the moment. And then this 39 million of deferred tax liability you have to pay possibly until the FID with Sea Line, or maybe first oil with Sea Line, can't remember which. And then we've got this 15 million other payables. I'm assuming that this relates to Sea Line work ramping up to the FID, and they can actually borrow money off Navitas to pay that if they want to at 8% interest. I don't think those costs will come in as a in the expenditure. Actually, they'll just appear as a debt, probably, I'm guessing, a long-term debt, and then the assets, the money that they've spent on developing Sea Line, will show up here on the assets side. all these years where I've been really wrestling with Rockhopper, with all the issues they had with their business and their balance sheet, particularly related to the legal costs and these Italian assets that were a bit like an albatross around their neck. Now, they've been able to withdraw from a lot of that. When we get to mid 2024, it's actually starting to look like a nice, clean income statement and a nice, clean balance statement. Then in October last year, they had a RNS that they were actually getting rid of these Italian assets that were left over to Zodiac for 5.5 million. So reading this, they basically are paying Zodiac 5.5 million to get rid of the Italian assets. But in return for that, should those assets get developed, they get a 10% royalties for that. Plus the cash burn, which is currently 0.7 million, which is their cost of sales. That's going to completely disappear, and these 20 million in provisions related to the Italian assets, those they get rid of those as well. So it's worth giving Zodiac the 5.5 million to get rid of the 20 million in provisions plus 0.7 million of cash burn. And then we see that, I mean, this obviously is the half year data, but when we get to full year, they're going to actually have really squeaky clean, pristine accounts, because for that 5.5 million, the cost of sales will diminish to nothing, saving them, they've said, 0.7 million a year. Plus the admin expenses will go down as well. And when we look at their liabilities, this 20 million in provisions, they'll be getting rid of that as well by getting rid of the Italian assets to Zodiac. So they're going to end up with a very pristine set of books here, even more so following the sale of the Italian assets to Zodiac. Then on the 25th of November, they did a RNS relating to the Navitas update. And this is the news item that led to this absolute surge in the share price. Now you can actually watch the Navitas presentation on YouTube. It's in Hebrew, but actually, if you use subtitles, you can kind of get 80% of what they're saying, and it's well worth doing that. But I'm going to do a separate video on just Navitas. But the situation with Navitas themselves, I think, helped boost the share price because they're going swimmingly well. They've just finished their Shenandoah project, and as you can see, that's actually a huge amount of money for them, and they've completed their fourth production well, and it looks like that's going to begin production now mid this year. And then they're going to be actually gushing with cash. So the money from that makes it a lot more easy for them to get a final investment decision for Sea Lion. The Sea Lion project is very important to Navitas. Here you can see the oil that brings in to their production from Sea Lion versus just the Shenandoah even. And then up here we can see the Sea Lion. It's still pre-FID, but this is the extra MPV10 that 2C that it's going to bring in. All the momentum is shifting in the favour really of Sea Lion going ahead as far as Navitas are concerned. And so this explains why the actual Navitas presentation and Navitas RNSs had a big impact probably in confidence in the Rockhopper share price. Now here's the Rockhopper RNS where they talk about the Navitas RNS, and I think another key fact was that they've actually signed the memorandum of understanding for a FPSO and begun the FEED, which is the front end engineering design for the FPSO. So this again is really positive news, which I think is the main thing that's driven the share price. Now, this slide I've ripped from an old Navitas presentation, and you can see that the identifying a FPSO was the objective that they were currently working on, and this task is now completed. So all that's left now is the FPSO feed, which they've started, and then the actual project financing and the FID. So this shows you how we are kind of in the end game now towards the FID, which kind of has to happen within the next couple of years. They've said it's going to happen actually this year. There's lots of, they actually updated their project plans as well. And I can give you a nice summary of that. So the exploration licenses, it's separated into the northern development area, then the central development area, and the southern development area. So initially, there's got this phase one, and then phase two in the northern area, followed by phase one in the southern area. So by using this floating production and storage and offload vehicle, which are these special boats, they're kind of like half oil rig, half boat. They can kind of quite cheaply get a lot of production out, and they'll do it in these phases. And this gives them a $24 per barrel break-even price. Now we've got the also from the Navitas website, I've got the competent persons report for Sea Lion. There we get our net contingent cash flow discounted to 10%, 2C best estimate coming in for Navitas at 3.5 billion. And then I've calculated from that Rockhopper's portion will be worth 1.9 billion. And so this is how I arrive at my estimate after taking account of tax. I think Sea Lion will be worth 1.4 billion to Rockhopper. And then that gives me a nice comparison of what I think Sea Lion's worth at first oil. And then you get a lovely breakdown of each of the resources within Sea Lion, how much oil and gas they have. I've not counted the gas at all in any of the calculations, but there's actually significant gas as well, actually. But we're just kind of, worst case, we're just dealing with the oil for our calculations. And then finally, we get this lovely cash flow data for Sea Lion. And so from this, we can have a look at how much Rockhopper and Navitas are going to have to spend to get this going, but then how much money is going to be flowing in once it's started. And I've put that into this chart here, which you can see better on my Excel. And so here you can see the capex and opex. Obviously, the capex comes to an end, and then you get this steady opex for as long as they're producing oil. And then from 2028, which isn't only like 3 years away, assuming they start this year, that is, they actually are kind of cash positive. And then you get this, I'm guessing once phase one and two are completed, absolute gushing cash here. There'll be cash raining down on Navitas and Rockhopper. The blue line's the Navitas share gross. The green line is the Navitas share net of discounted cash flow and stuff. And then for Rockhopper, the Rockhopper portion of discounted cash flow is in blue. And you'll see, Rockhopper will be bringing in a good 300 to 400 million every year for quite a number of years once this gets going. So that gives you some kind of idea how undervalued Rockhopper are first, if you think that first oil is very likely. And I've broken that down here into this table. And so we have, in terms of MVP 10, Sea Lion's worth 1.9 billion to Rockhopper, which is how I made my table here, and 3.5 billion to Navitas. But they've got to put in 1.4 billion of capex pre-first oil and 4 billion in total. So Navitas are going to have to raise it works out about 1.4 billion, and then they'll be lending Rockhopper about half a billion. I think that I've calculated roughly that pre-first oil, Rockhopper will have to raise about, let's call it 200 million or 170 million. I think that will be very easily achievable. I've got no worries about that whatsoever. Plus, of course, Navitas will be lending Rockhopper the other money they need pre-first oil at 0% interest. In the next few years, Navitas have to come up with perhaps zero point 0.6 billion or something, and then when we get to first oil, you see how they need this 1.4 billion. If you look at the share price of Navitas, you see how well people think they're doing, and then when you look at their update that Shenandoah is a go halfway through this year, you really can see how it looks very likely that Navitas are going to raise the money to actually make this thing happen. What I would say, however, is they've said it's going to all happen mid 2025. My kind of gut feeling is it will be a bit late, and that maybe Shenandoah is a bit late. They're going to want a bit of money coming in surely before they then commit to Sea Line, and I can kind of see the FID for Sea Line slipping until early next year, but it is looking very likely it's going to happen based on what we know about what's going on with Navitas. Let's have another eye-watering look at the kind of money that should be coming in for Navitas with Shenandoah as early as 2025, 2026. I think it's highly likely they can raise the money, but don't bank on it happening in mid 2025. My gut feeling is it won't happen till early next year. So what's my strategy for Rockhopper? Well, based on my estimation here, you've got to consider this an estimation with large error bars, but still my kind of rough estimation is that Sea Line's going to be worth 1.4 billion, which is like a 7x from their current market cap. So I work out that from where they are now, that 7x would give them a share price of £2, which would actually be roughly a 20x from my initial investment. So that's kind of my what do I think Rockhopper should be worth with a first oil in Sea Line? I think £2. So the question is, what's going to happen now? And is there an opportunity really to cash in even before we get the FID? Well, what I've noticed is when you go onto the daily timescale, what we have here is actually quite an orderly repricing over actually quite a long time and of several months. So what we have here with the price, it isn't really a moment to get all excited and want to jump in quick, or sell quick. I think this is an orderly repricing, and I think this will be large money, large institutionals, so large asset managers actually perhaps coming in and buying it up is kind of what I associate with this orderly increase. I've got here the shareholders for Rockhopper, and there's only one large asset manager being ADOS here with 8%. There's no other large institutional interest with enough shares, that being 3%, to show up. And I suspect that we're going to start seeing some large institutional holders showing up, and that will start coming out in RNSs and kind of explain this price movement. But as long as we're below 50p, I kind of don't think it's worth getting out of bed for. So I'm going to wait. If I see us breaking out of this and kind of plateauing above 50p, then I'll have a think. Also, I'll be looking for, if we suddenly get like this massive parabolic move up, that would be a good time to think about exiting. But I'm certainly not even going to think about exiting until above 50p. And then really, anything above 10p, which will be a 10x for me from my initial investment. For me, it makes perfect sense to just miss out on the further gains, but in return for that, you get like a 10x with no risk. If I was to sell, though, I wouldn't sell all of them. I would basically enjoy the 10x returns, cashing in most of it, but I'd probably keep 20% of it or something, or whatever would be like, say, 5% of my overall portfolio. I'd still keep an interest for all the future excitement, but I would definitely be up for selling most above £1 for sure, maybe less. But I'm going to basically play it by ear at the moment. I think this at the moment is only an orderly repricing. Keep an eye out for the RNSs of large institutions coming in, and look out for a kind of plateau or a parabolic move up as perhaps good opportunities for me to cash in here, but still have a nice portion to enjoy the future of this company. So that completes my update for Rockhopper. I'm going to do one for Navitas soon because they're very interesting. But I hope you found this useful, and good luck with your own investments. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.